We are going to go through Chapter 5, Number 32, and this one, I believe, has inventory. I thought this one had fixed assets too, but maybe it just has inventory. Okay, so let's get started. Where we can, we're going to do a purchase price allocation. What we want from the purchase price allocation, though, is to get the assets and goodwill. So January 1, 2016, which is an important date, January 1st, 2016, because I need to know how far to bring it forward. We acquired 80%, so that's also important, of the outstanding stock of Sander. So Sander is the sub, so sometimes I actually put that also. So I have Plymouth as the parent and Sander is the sub. So put a P. A lot of times they have the parent start with a P and the sub start with an S. So Plymouth is the parent, Sander is the sub. Exchange for 1.2 million cash. So I've got that. At that time, their book value was $925. So I'm going to leave a little space and remember that. Their total business fair value of 1.5 million, so I can back into their non-controlling interest of 300,000. Neither Sander has neither issued nor reacquired any shares of its own stock. So far right now I know that we purchased it for 1.2 million. The entire purchase price is 1.5, which leaves the non-controlling interest of 300. We know that the book value is 925, so right now we know we're stopped here. The excess is 575,000. Says this one, the book values, individual assets and liabilities approximated their acquisition fair value except for a patent, which was undervalued by 350,000. So I have a patent, 350,000, and any excess is attributable to goodwill and no impairments have occurred. So I can assign 350 to the patent and the excess 225 goes to goodwill. It tells me the patent has a 5-year life, so I divide by 5 is 70,000. And I know I can kind of peek down below and it says December 31st, 18. And so I want to do a worksheet for December 31st, 18. So I bought it on January 1st, 2016. So I need to bring the balance of these assets to January 1st, 2018 for entry number 2. Because entry number 1 and 2 are as of the beginning of the year, not the end. So I have 2016, 2017. So my amortization is 70,000 a year. So 350,000 minus 70,000 times 2 gives us 210,000 left. So 350 minus 140,000 is 210. Goodwill is not amortized, so I still have 225,000 in it. All right. This one, it tells me my inventory sales, and it tells me my ending inventory, but this only gives me my gross profit rate. Well, if you recall, gain divided by transfer price is the gross profit rate, so they're giving me this number. So they give me 2016, 2017, 2018. Well, 2016 is really not applicable because I only need beginning inventory and ending inventory. So I can take 2017 as 28% times the 125,000. That's the 35,000. And then the next year is 25% times 160,000, because remember it's gain divided by transfer price times ending inventory. Here's my ending inventory. And there's my gain divided by my transfer price. So I've got 140. So here's the number that's important right there. There's the number that's important. So I really need this transfer price for my intercompany sales, but it does tell me that intercompany sales were 300,000. So I know that the gain divided by the transfer price, this transfer price would be 300,000. So I've got total sales. So there's my 3 numbers there for my inventory. Okay, so I'm going to clear all this. Okay, now I can do my worksheet entries. Oops. Okay, so here's my where in the world did it go? It disappeared. Okay, I found it again. Okay, so one thing that I want to do that I didn't do until later is to figure out my equity income and to figure out what method they use. Okay, well, remember I've got the initial value, the partial equity, and the full equity. So the initial value would be dividends, and remember I own 80%, so first of all, one reason I know it's not the initial value is it has equity and earnings of Sanders, and if it was the initial value, it'd have dividend income. But anyway, if it did have a number up there, it would be 25,000 times 80%, because dividend income would be on the parents' books, and notice that 25,000 times 80% is not 124,000. The next thing it could be is the partial equity method. If it were the partial equity method, it would be 230,000 times 80%, and that is indeed not that. So I'm going to do this equity income computation here. Try to scoot this over here. Okay, and I start with the subs net income right here. Subtract amortization. I should do this with the purchase price allocation. I should have done it up above, but I didn't. So I have 230,000 minus amortization is 160. Then I'm going to adjust for upstream items. I really should have mentioned that, but I did write it here. So notice that these intercompany sales, Sanders sells to Plymouth. So it's really important to know that if these are upstream or downstream. Notice that I know in my equity income computation, I do subs net income minus amortization, then take upstream items, and then take the ownership percentage, and after the ownership percentage, I take downstream. So now I'm stopping to figure out, oh shoot, I forgot to do that. And I'd done it when I did the problem, but right now talking about it, I forgot it. And so these are upstream, so what I want to do is take out the 2018 inventory, because that gain to myself did not happen, and add back in the 17 gain, because what I assume is inventory that's not sold in one year is sold the next. So next year I'll be taking out 2019 and adding this 40,000 back in. So I have 35,000 added back in because that's beginning of the year. Take out the 40,000. Remember, I don't do anything with this because it's a wash. The entry is sales, cost of goods sold. And again, if you feel better to make the 3 inventory entries right now when you have these, that's great. And you can see that I'm going to debit sales and credit cost of goods sold for those. Could actually squeeze them right in there if I wanted to. Probably make sure somebody can read them, but anyway. So I'm down to 155,000, 155,000 times 80%, because I always take my ownership interest after upstream to get 124,000. At this there's no downstream sales, so I'm done. Same time I do non-controlling interest, try to take the 155,000, it kind of cut off there, times 20% is 31,000. Okay? All right, so now I'm ready for my entries. First entry, eliminate subs owner's equity. Look, I forgot to make copies of this problem and forgot to finish it. So I go over here, and the subs common stock is 800,000. The additional paid in capital is 100,000, and beginning retained earnings is 345. I put that in parentheses because I don't know if any of these entries will be affecting retained earnings. Honestly, I do know whether they're going to affect retained earnings because they're upstream, and they will. Okay, so anyway, remember that. So I'm going to put 345, and I'm going to finish it later, but I'm actually going to remember to finish it. Second one is adjust the assets to fair market value as of the beginning of the year, so that's 1/1/18. And so I see I have my patent at 210 and goodwill of 225 and the investment at 80/20. Okay? The next thing I do is my equity income. That's equity income, not ending inventory in this case. So equity income is right here, 124,000. 124,000. I've proved that it's the full equity method, which is great because I'm going to show you the worksheet in just a second where I have a check figure. But I also want to write down the non-controlling interest column is 31,000. I do my dividends next. So dividends declared against the investment. Notice I have $25,000 of dividends. 80% is $20,000 and non-controlling interest gets 5. So down here. I record my amortization expense, which is $70,000 against the patent. I do my 3 inventory entries. So remember, $300,000 for current year sales, $40,000 for current year gain that I'm removing, $35,000 for prior year gain that I'm adding back. Right? So get rid of the sales against cost of goods sold at $300,000. Get the inventory down by $40,000, and then it's upstream, so I debit retained earnings and credit cost of goods sold. So now that I've debited retained earnings, since I didn't do this here, I'm going to try to draw it in. So I already have $35,000, so $35,000 there. Pretend I can draw with this. Okay, so $35,000. I'll see if I can use this text thing. So that means $345,000 minus $35,000 is $310,000. It's not working. And then my investment account will be 80% of these 3 numbers and 20% of those 3 numbers. I'm not going to type it, it's not working. Okay, let me clear all that and go back. Okay, so now I'm going to show you the worksheet. And I can tell you what the 80 and 20 on that first entry was, but the 80 would have been 968 and the 20% would be 242. Okay, so in the worksheet, all I've done is post the above entries that I hand wrote up here. So let's check one out. Retained earnings, cost of goods sold. And right there is my retained earnings, cost of goods sold. So there's my 310. So you can double check them. Okay, so don't forget to put how I do this non-controlling interest column is I basically add this 242 and the 87 to get the 329. So it's coming over here. I book my 31,000 and my 5,000 from entries 3 and 4. And I have beginning non-controlling interest plus net income minus dividends equals ending non-controlling interest. I add all of these across, the total's down. So once I add all these numbers across, add the total down, add my non-controlling interest there. And remember, non-controlling interest is how much of this net income we don't own, so it's a subtraction there. So $700,000. Now I've got my check figure. Because this is the equity method, those two should agree. I bring this $700,000 down to there and write it in. I add the other 3 lines across, then add them down. And I get $3,300,000 since it's the full equity method. Oops. Since it's the full equity method, these 2 columns should agree. That should agree. Okay. Then I bring this line down to here. Add the other lines across, the totals down, and that's the parent's actual equity, which should be the subs. Okay, and so that's problem number 33.